I think I know everyone that's on the Zoom today, but I'm Scott McCammon, President and CEO of the Milton Chamber of Commerce, and I want to thank everyone for joining us today. It's there's no doubt that this has been an incredibly challenging year for all of us and our peers in business and people in general. But hopefully, with the vaccine rollout and the easing of restrictions, there is a bit of a light at the end of the tunnel. But even with that, there's still confusion about finances, about all the government programs that have been rolled out in the last year, and even the tax implications of some of the COVID subsidies. So, to help all of us, we're really proud to have James from TD Commercial Banking and Ramki and Mustafa from SB Partners joining us this morning to ensure that all of us are ready for that new normal. So it's now my pleasure to turn the session over to Ramki to get us started.
Thanks, Scott. You really said it. The new norm is going to be probably the one to be remembered going forward, not how we lived and how we managed our business. So thank you for the introduction. It was great. And it's an absolute pleasure to meet everybody here. And I'd like to start off with my presentation here. The topic I'm going to be talking about today is what's the new norm, and how do we build resilience in the company, and how do we manage the current situation that we have, and how long is this going to last, and what is important for us to focus on during this COVID-19 pre and post-pandemic period. So the topic today I would like to really stress upon is building resilience through better financial management. And I can't emphasize enough about the importance of financial management. But over the last 1 year, since we started SB Advisory, we have seen businesses really ask questions about, is my financial status good enough for me to make decisions? And how do we get better in understanding the financial statements? We spent quite a lot of time educating people about the nuances of reading financial statements. So the new norm will start with having a very good, sound understanding of financial reports, and also how you manage financials. So as we all know, business is a marathon, right? So why we train like a 100-meter sprint, why we look like a month to two to a year or more than a year, and are we really prepared to manage this business going forward? We all know that COVID-19 impact will be felt for at least a year or two more, and as Scott mentioned about the vaccination, vaccination will roll out, but the confidence of the businesses, how they've been asked to manage the crisis, that will take some time for recovery. And so we all want to understand, and start our journey by understanding the end goal during this post-pandemic or during the pandemic time. So the new norm is going to be that the businesses will be expected to be more agile. So one of the top questions that we receive almost from all businesses is that we are seeing that our sales are slowing down. And well, this was well predicted because last year, a lot of the expenses, a lot of the projects were committed, and they were not in a situation to react and pull a lot of these contracts, although some did. So some businesses, experiences a stable sales or marginal decline in the sales. But what has actually happened is, a lot of businesses have woken up and said, how do we look at our spend? As much as we are looking at our financial statements and also our business finance, every other business is looking at it. So really have to encourage people to look forward. And it is, we are not left alone in this race. We have other players who are also going through the same thing. So the important aspect here is that who's focusing on those lead generations? How are we tapping our opportunities? How far can we go back and look at the opportunities that we ignored during those times that it may present itself to help during this COVID-19 time that we are experiencing? The second thing is cash is king, and you have to manage your cash budget very tightly. When I say very tightly, it doesn't mean that we go about cutting costs where we can without looking or understanding the long-term impact of those decisions. And also, do we have the most recent financials? So I'll talk a little bit about what is meant by financials, what we need to see as a standard package to manage our business better, and also when we should be looking at it. We have to put some trust on our accountants and start asking questions, and also look at are we looking at analyzing our financial statements, the relevance of these analysis, and how you use them in our business decisions. So that is very it's not something that we can develop overnight. It'll have to come in over a period of time. But one thing I'll really stress upon here is that when we look at analysis, we need to look at a good broad spectrum of period. Otherwise, we'll be pretty focused on the period where we are looking at to control costs, not understanding what was the driver of the business. So generally speaking, business drivers are like, what generates volume of sales for you? How do you increase your opportunity, and how do you really manage the volume of sales, and how sustainable are they? Also looking at optimizing the infrastructure. A lot of people have started working from home, and it has made some of the fixed cost model to be considered for a variable cost model. For instance, I've seen businesses, they've vacated the premises and they have gone into work from home strategy as a permanent solution. And even large corporations have adopted that. Like they're saying that if you choose to work from home, this is our expectation, and defining that more clearly. The other opportunity, I think, at this point is looking at the supply chain and say that, we are being affected. We supply your products. We are using your services. I know that because we are not, buying enough from you, your business is also affected. So how can we work together to come out with a promotion that we can pass out some of the benefits to our customer, yet we are sustaining through this period? Today, profit is not the motive, cash is the motive. Like, can we generate cash enough to pay our expenses, keep up with our living, and pay our employees well, retain the talent, so that we're not creating this infrastructure after the pandemic period. So it makes sense. I was talking to a business earlier this week, and they asked me, like, do you think that we should be talking to a supply chain, and how do we do it? I said, if it warrants us to drive to Montreal to have a conversation, let's have it. And that is the sense of urgency in terms of talking to a supply chain or other resources. If a decision has to be made, it has to be made now. That's a sense of urgency. Also looking at the ERP system, and I think, last 1 year, I've really seen so many businesses come in and say that I want to make good decisions. How do I do it? And my first question is, what kind of ERP system do you use? And are you, you moved to a work from home situation, but is your ERP still an on-premise application that people have to log in? You have to increase your infrastructure bandwidth. Are you cloud-based? So essentially what turned out to be is a lot of people were trying to make the ERP work rather than ERP working for the business. This is the time that it's a wake-up call to say, how do you simplify, how do you reduce your complexity on ERP systems, and how can it make work better for you? Are these reports standard reports, the variance reports, everything coming out of the system that help you analyze as you are working through the process or manufacturing cycle? Last but not the least, the government grants and subsidies going forward. Last year we saw quite a lot of subsidies were rolled out from not quite a lot, but in terms of what it was needed, it was rolled out. And going forward, are we going to get? And one of the things that I've been hearing a lot is these subsidies are no longer going to work. So on one side, as Scott mentioned, these subsidies are taxed, and it's taking out of the cash from the business. How do we sustain going forward in case these government grants are not sustainable? The new norm is also to look at objectives and key results areas. And this has been a phenomenon, a theory for a long time for people looking at strategy. And businesses, when they look at objectives and look at what's our vision, like, the vision can be distorted now because of the COVID, but keeping the focus on the vision, and these are temporary phases that we'll have to go through. And temporary, as we define as a new norm, can be a year, 2, 3, 5 years, could be anything. But end of the day, the vision will have to be set in focus, and we have to follow that. And setting some objectives and key result areas amongst people will ensure that everybody are participating in achieving these objectives. And these objectives and key results areas are not necessarily performance metrics, but these are pretty much to manage your business more effectively and efficiently. And last but not the least, investing into people to work from home, right? This is not the people who have been micromanaging people have been faced with a different challenge now to say, I have to trust my employees. How do I create a home infrastructure? How do I supervise their work without really looking over their shoulder? Are they, enjoying a very healthy mental and physical health, and also expecting people to be on site and also work from home? How are they going to interact from a culture standpoint? So we all know that culture drives the organization's performance, and work from home has actually distorted it. But people are now, very desperate to get back to work, and they wanted to build a culture. Man, people being a social animal, we need to interact with people. Otherwise, there's no excitement. And developing some standard operating procedures, for the critical functions and the processes will be a starting point for us, because processes will define how effectively we manage our infrastructure, and also look at data security and management while people are working from remote locations. This has gained a lot of importance, not just because of COVID, but I think the way the industry is going, that a lot of the solutions are now cloud-based. Cloud-based approach to started about a couple of years back, even before the pandemic started. So data security, data management, it's a heavy topic. More than happy to answer any questions on that at a later point of time today. We talk about ingredients of a good management pack, and this is a pretty new term for some people, but SB Advisory, we use this terminology a lot. Management pack comprises of financial statements, but also it has got other stuff. So when you look at a traditional financial statement or information that comes to a business owner, they pretty much get balance sheet, income statement, cash flow statement, and some go to the extent of looking at gross margin reports. But there's a lot more to it, because when you look at your financial statements to analyze where is my value add, and what am I supposed to put my magnifying glass to say, does this cost, if I cut it, will it impact other areas of my operations or business? So the few other things that we recommend businesses to look at is gross margin reports and contribution statement or contribution margin statement. Now, contribution margin statement has started becoming very important, and a lot of businesses are benefiting out of it, because you can understand what's your level of fixed cost and what is my minimum break-even sales that I have to achieve in order to meet my fixed costs and sustain through this period and preserve my cash. So this is gaining a lot of importance. So if you're, as a business, we highly recommend to look at contribution margin statement and understand the relevance between a contribution margin and a gross margin. Again, more than happy to answer any question, but these are terminologies used in a typical business environment, and accountants do understand this. Looking at full suite of ratio analysis and KPIs. This talked about more like a balanced scorecard, where you look at both financial and non-financial metrics to see, am I getting enough productivity? Are my ratios in line? Am I having a covenant that I should be tracking towards? Should I be talking to my financial institution because my financial ratios are going to be impacted at the end of the year, but I am proactively analyzing this, and I'm talking, I create an opportunity to talk to my bank. I think James will probably bring this up as to how important it is to understand the trend of these ratios, and also ensure that the business financial statements are closed on a particular date, like on the 10th business day. You're not delaying the process, and you have the information. So this has played a big role where opportunities are presented at short notice for any opportunities for mergers or acquisitions. So it's always great to have these things closed on time. Last one is about, why does an organization need support in these areas? And some of the areas that we have listed here, it's a big laundry list, but I'd like to stress upon only one important aspect, which is costing and cost management. It's one of the least discussed topics in most organizations. They don't look at costing and look at pricing and see how it is impacting the management of the company, how you price your customer, and are you gouging your customer, are you underpricing your product? So I will highly recommend people to really look at costing and cost management as one of the top areas of value-added areas they should be looking at. And also look at strategic and business process improvements. So some of these topics are really, it's for a long-term sustainability, and investing into these ones and looking into these areas to say, do I have information? Is setting up the business for a better, position in the next 3 to 5 years. So with that, I'd like to hand over the presentation to Mustafa, who's going to be talking about how do we manage opportunities and risk better, and what are the important diagnostics, and he'll really pour some insight into the areas now. Thank you.
Thank you, Ramki. This was great. I'll just share my screen here and get this up. Okay, is that okay? I think that's up, right? Ramki, can you let me know if that's if everyone can see that?
Looks good. Yep.
Okay, perfect. Yeah. All right. So thank you. Yeah, thank you. That was a good segue into my session. As kind of approximately 1 year, a little less than 1 year ago, when the world hit a pause button or maybe even a stop button for a lot of businesses. There were some businesses that kind of closed their doors forever. Some it took a bit longer for them to shut down when the pandemic hit, and then they actually prospered in this environment. So historically, where we have businesses focusing on just sales and profitability, that may not necessarily have been the reason why certain businesses shut down. And I think Ramki's presentation alluded to, some of the reporting that one needs and information, financial reports, both financial and non-financial reports that a typical business needs to evaluate, how to survive in this kind of environment. It's not just about sales and profitability. There's a lot of other considerations that go into this. And ultimately, it's a major event that really highlights the company's weaknesses. You may be running along, going just fine until something big happens, and then something falls. Something is a crack, kind of. There's a fault line somewhere which causes your business to fail. So at SB Partners, we have a diagnostic tool called MORE, which really stands for Managing Opportunities and Reducing Exposure. And that's very similar to you going to the doctor and going for your annual checkup, where the doctor looks at certain things. He'll maybe check your heart rate, test your blood pressure, ask for some blood work, test your blood pressure, get some blood work done. And ultimately, give you kind of a report saying that, well, we think you're doing well here. These are a couple of things you can improve upon. And if you want to live to see, if you want to be 100 years old, this is kind of what you need to put in place today. So no different from a business. We look at, the MORE program we've developed kind of is a diagnostic tool that looks at all components of the business. And it spits out a report and says, well, this is, what we think you need to do to kind of work on the different elements of that business, of your business, for you to be successful. So I'll go through a couple of things which are opportunities and some risk areas, and we'll highlight a couple of things as we go forward. Government programs, I wanted to mention that simply because, a lot of our clients, and businesses in general have taken advantage of these COVID programs. The wage subsidies, the rent subsidies, the forgivable loans. So that's something that's been very evident over the past year. However, there are other programs that have always existed, and then there are other programs that kind of come and go and at different levels of the government, be it federal, provincial, or even at the local level. Two quick examples, right off the bat that I can think of is the SRNED, which is really the Scientific Research and Experimental Development Program, and also the IRAP program, the Industrial Research Assistance Program. Those are two that are there for, which are really geared towards innovation. But there are a lot of other programs, I said, at the local level that one can take advantage of. And I'll give you a simple example. I have a client that has revenues of approximately $700,000. It's a software development company. They've developed this unique solution for a problem in the education industry. And over the past 2 years, they've received approximately $300,000 in SRNED tax credits. So relative to the size of their business, relatively not that big if you consider it. But the grant they received, or rather the tax credit of $300,000, is significant compared to the size of their business. So very lucrative programs. One might ask, where do I get information on these programs from? I've often found that, the chamber is always a good source of information for the programs. And maybe at some point, Scott, you can chat about that. Tax planning is critical. Again, for every, this is, you sharing your hard-earned dollars with the government. In certain situations, for every dollar that you make, you could be giving over 50 cents to the government. So tax planning is really where you structure your affairs so that you pay the least amount of tax possible, which means more in your pocket, and still fall within kind of the tax rules and regulations. I had a client, who recently said, well, my business has not done too well in the pandemic, so thank God, we made a loss this year. I don't have to pay any taxes. But I guess the real point is that paying taxes is a good problem to have. We just don't want to pay more taxes than we have to. A very basic example I can use is for, say, a sole proprietor who might, be earning income in excess of his needs, and maybe he's paying tax at the highest marginal rate. A simple solution like incorporating your business, if possible. For every $100,000, that sole proprietor, now that he's incorporated, may potentially defer, approximately $40,000, up to $40,000 on $100,000 of income. So significant tax deferral there and more cash in your pocket ultimately. Business process and technology. So business process, really, if you look at your business, it's, from the time you get that order or phone call, up to the point where, the cash is in the bank account for any product or service that you've delivered. So that's really your entire business process. Technology really is one of the tools for you to be able to deliver that product or service. So technology is one of the tools that you're going to apply to that business process. One year back, if someone had told me that, well, you're not going to, you won't see your clients, you won't be physically meeting your clients for a whole year, I'd probably have said, what, I might as well pack up shop and go home because I'll be out of business in no time. But, here we are today. Fortunately, we've been, fairly successful at that. And what's enhanced that is the technology. A simple example is this Zoom call, and that's what's enabled us, to keep in touch with our clients and to make sure that we're able to continue delivering our service and product. Along with technology comes, cybersecurity issues. Obviously, I'm sure you've all received that, spam email that says, hey, click on this link, you've won $1 million, just provide your bank account details. So, we have to critically look at, technology hand in hand with cybersecurity to make sure that we're protected at all times. Employees, this is really about having the right people on the bus in the right seats. So if any of those are, if that mix is not correct, you have the wrong people or you have the right people in the wrong seats, well, it's just a recipe for pretty much disaster to a large extent. Some businesses have failed not because they didn't have sales or profits, it's because maybe, well, they didn't have the right employees. So, so kind of in this new environment, once it's a question of, okay, once you've recruited this employee, and the way we are recruiting is a little bit different from what we may have been doing in the past. And in the past, when we were physically interviewing candidates, now it's probably done over Zoom meetings or other electronic means. And I've often heard complaints that people can't see the body language. So is there anything you need to do to compensate for that? Maybe there's some other psychoanalytical tools that you potentially might need to use for that. So that's something a business has to explore. The other thing is, once you get that employee in the door, how do you keep that person incented and motivated to continue working? If in the past you were, your catchment area was really your local region where you were sourcing employees, well, now that maybe the business has gone virtual, does that kind of open up opportunities to, increase that, widen that catchment area from which you can get employees? The other critical element is cross-training of employees, where we found often with a lot of our clients that, they said that, well, my AR clerk, accounts receivable clerk is a young family, unable to work. So that's why we're behind in collections. That behind in collections could be the difference between, business success and failure. So having another employee cross-trained for certain functions will only add to the strength of your organization. Business succession and planning, when we look at that, it's really when you're starting a business or growing a business, it's kind of starting with the end in mind. What am I going to do ultimately? Where am I headed? What am I going to do with this business once I'm ready either to, once I'm ready to wind up? So with the pandemic, obviously, a lot of businesses, but, it's possible that, well, maybe they did have to shut down. They could have stretched it a little bit longer and potentially looked for an exit plan. There are ways to structure an effective exit plan. Be it you're passing, you may be passing on the business to a family member, be it the next generation, or it could be employees, or even selling to a third party. There are creative ways to make this transition happen, and more so from the perspective, both from the perspective of kind of the buyer and the seller. From the perspective of the buyer, it can be structured in such a way to make it least impactful from a financing perspective, and from the seller's perspective to have it in such a way that there's least tax paid upon the sale, and that that leads to a smooth transition overall. Business continuity planning. That's historically we've always looked at this from the perspective of a disaster recovery plan, for example, where you're looking at, okay, how do we recover from the effects of a fire, a flood, or maybe even an earthquake. But really, the pandemic has shown us something a little bit different, that there's other things to consider besides those major events. They could be little things that impact your business as well. So really, this is doing kind of a risk assessment on a frequent basis and updating that risk assessment. In an environment like today, well, one of the risks is, okay, this employee, this AR clerk, well, this person cannot work. There's a lockdown, kids are at home, this individual will not be able to work. What's my plan B for that? So those are the things. It's not just a fire or flood or something really big, but it could be something as little as that needs to be considered when you're considering business continuity. So really, that's having a good document of all the individual risks, and then how to address those risks as well. Simple is that with the pandemic, we internally, at our office, we had a pandemic committee that would actually look at all the new, the new information, monitor the news, and anything that new that was being kind of announced on a daily basis. They'd monitor that and then bring it back to the office, and we'd end up implementing it almost right away. Financing and cash flow. So this is one of the biggest ones. And that could obviously be the difference between success and failure. With respect to the proper financing structure and reserves, do you have James Fawcett at TD Bank in your back pocket? That's critical. So I'll let him talk a little bit more later on the financing piece. But one of the key things is your financing structure appropriate? Do you have the appropriate, do you have the lines of credit in place? If you're buying long-term assets, is that being funded by long-term capital? So those are things that you have to analyze. And, a good idea is, Ramke alluded to the management packs and kind of the ratios of key performance indicators. And those are things that you should be evaluating as part of that process. Reserves to fund operations. You know, do you have a backup plan? You know, do you have, you know, personal funds that you can pump into the company? Do you have them sitting in a holding company, for example? And what's the best way of getting those funds out, you know, in a tax-effective manner from different sources? Cash flow, again, you know, Ramke, I think in more than once mentioned that cash is king, or cash is critical to the business. Really, it's the blood of the business. So I'm going to kind of look at 4 components here. One is pre-billing. So for example, you know, in the past, if you've been billing after the job is done, can you now bill, you know, say 50% in advance and then 50% on completion? Often, you know, in construction industry, that's very common, but it could be also very common for your business now. And that'll just ease cash flow constraints. Accelerate your billing cycle. If a job is completed on the 10th of the month, you know, do you have to wait till the end of the month to bill it? No, you don't. You could probably bill it on the 11th. So speed up that process as well. Increase your collection cycle, which means really that historically, if you're looking at anything, you know, that's older than 60 days, well, maybe you should reconsider and, you know, start looking at something that's 15 days old. Because if it gets to 60 days, potentially, you know, your customer might be out of business as well. So the faster you get that money in, much better for from a cash flow perspective. Credit policy and customer base, you know, extending credit to customers. If, you know, in the past it was, you know, $10,000 credit you were, you know, granting customer A, well, you may want to reevaluate that. In this environment, you may say, well, 5,000, you know, for the next few months until things get better. You know, review your customer base as well. Should we be extending credit to certain customers, or is it now cash on delivery? You know, sometimes it's probably better to lose a customer than to have a customer that doesn't end up paying for a service or good that you've provided. On the government programs piece, I wasn't going to talk too much about this, and the reason for that is CRA has, you know, recently did a webinar. There's some good material on the CRA website as well. They have some good webinars that they've released. So those go into significant detail on the different government programs. I just briefly wanted to mention that, you know, most of these are taxable. So that's the underlying thing you need to be aware of, that, you know, the wage subsidies, the rent subsidies, those all end up being taxable because either they're a reduction of your expenses or they're, you know, income to you or to your business. With respect to the Canada Emergency Business Account, the CEBA loans, you know, for those of you who have taken advantage of, you know, either the $40,000 loan or the $60,000 loan, there's a forgivable component. And if you don't intend to pay it back, that forgivable component becomes taxable pretty much right away. And with the respect to CERB, I'm sure, you know, most of you that have taken advantage of the CERB program, CERB benefits, you've probably received a tax slip saying that include this in your income tax return for the 2020 year. So that's all I had. You know, I'll hand it over to James. And if there are any questions, we can always address them later. If once again, these slides also, if anybody's interested in both Ramke's and my slides, we can send them to Scott and he'll make sure that those get distributed to you. So James, I'll hand it over to you to talk about kind of the piece.
Yeah, that's great. Thanks. Thanks, Mustafa. Thanks so much, both Ramke and Mustafa. There's going to be some good overlap in what I'll be discussing. So great segue into the financing part of it. I'm just going to get my slides up here. So bear with me for one second. Okay, so can everybody see the slides okay?
Yeah, your slides are up, James.
Okay, that's great. That's great.
The PowerPoint, maybe you want to put it on slideshow?
Okay, yeah, it's looking a little small. Okay.
Yeah.
Let's just.
Perfect.
Is that good?
Yeah,
Does that look
good.
okay?
Yeah.
Okay, great. Okay, well, yeah, thank you again, Ramke and Mustafa, and thank you, Scott, for the introduction, and to the Milton Chamber for having me on today's presentation, and good morning, everyone. So as Scott mentioned, my name is James Forsyth. I'm a senior manager of commercial services with TD Commercial Banking. I work out of our Halton office, and I'm responsible for leading our our team of commercial account managers, and we primarily cover Milton, Oakville, and Burlington out of our Halton office. And today I'll be discussing new normal ready from a financial and banking perspective. Let me just move on. I'll be speaking about how COVID has impacted senior lending, speaking about some of the COVID-related financing programs that are available, and then concluding with some other tips and strategies for everyone to consider. In terms of senior lenders, so when we look at small business banking and commercial lending, the banks classify themselves as senior lenders and as cash flow lenders. So what is a senior lender? What do we focus on? As a senior lender, we're conservative, low risk, lower price lenders that focus on cash flow and collateral. So I want to emphasize that we are cash flow lenders. It's not enough for us to have a strong piece of collateral to be able to finance a deal such as real estate. We also need to be very comfortable with the company's cash flow, the sustainability of that cash flow, and the company's ability to repay a loan from its cash flow. So COVID's undoubtedly impacted cash flow for businesses across all sectors. So how has that changed banks' underwriting processes? Number one, banks are and have been open for business. So starting back in March of last year, banks were participating in numerous COVID-related restructuring programs, such as operating line bulges and principal payment deferrals for commercial clients. But even beyond that, we're still doing lots of new client onboardings, lots of new fundings have been happening throughout the pandemic. In terms of what's changed in our underwriting process and risk appetite, is we're now including analysis on COVID impacts to businesses on any renewals we're doing, any new deals that we're doing. So first off, generally speaking, our policies and advance rates have not changed. So we're still lending at the same loan to value ratios against accounts receivables, inventory, equipment, and real estate as we were pre-COVID. However, we're now looking at impact to revenues during fiscal 20 and fiscal 21, projected debt serviceability, and access to liquidity when we're underwriting any new loans or any new credit requests. So in terms of cash flow, which again is extremely important to commercial lenders, we really need to get an understanding of what a company's cash flow will look like going forward, both in the short term during COVID as well as in the longer term post-COVID. So for example, if your company manages multiple dental clinics, how will the new COVID-related protocols impact cash flow, given that you'll have potentially less capacity, more time in between patients to sanitize, consumption of PPE, potentially new CapEx requirements, or conversely, say your company is a manufacturer and you pivoted into PPE, we'd want to understand what's the sustainability or longevity of those cash flows associated with the PPE. So the key message here is that we're looking at what's going to be happening beyond COVID and considering longer term impacts from COVID. So once things do return to normal, what does that look like for your business? If your company has been struggling throughout the pandemic and struggling to obtain conventional financing, the good news is that there are some programs available through the banks that may help, which I'll now discuss. So the first program, which I think everybody is probably familiar with, is the SBA program. So this program provides you with a loan that has partial principal forgiveness. The program was rolled out last year for a $40,000 amount, but was recently increased to $60,000. So the loan is interest-free until December 31st, 2022, switches to interest only from 2023 to 2025. The interest rate is 5%, and the loan is to be repaid in full by December 31st, 2025. If only $40,000 was funded, $10,000 is eligible for forgiveness if $30,000 is repaid by December 31st, 2022. And if the full $60,000 was funded, then $20,000 is eligible for forgiveness if $40,000 is repaid by December 31st, 2022. And the deadline to apply for this program is until March 31st of this year. The next program that I want to talk about is the EDC BCAP program. So this is a program with Export Development Canada that allows companies to apply for a new interim demand loan to provide additional liquidity by financing operating expenses. So the program can't be used for non-operational purposes such as paying out dividends or repaying existing debt, but must be used for operational purposes. The maximum loan size is $6.25 million, and EDC guarantees up to 80% of the loan. The guarantee from EDC is valid for up to 12 months and must be renewed annually, subject to a total period of 5 years. And this program is a solid program since companies can potentially qualify even if they aren't exporters, which is EDC's typical mandate. So the loan is structured as a demand loan with multiple drawdowns permitted, and repaid amounts can be redrawn. So it works almost like an operating line. A key item here, if you're thinking that this program could be right for you, is having a repayment plan, considering that the EDC guarantee can only be renewed for up to 5 years. So it's not as if you could just have this facility that's staying out there for an indefinite amount of time. And I will say that with this specific program, it is geared more towards commercial banking clients. So at TD, it's issued through our commercial banking channel. It wouldn't be available through the small business banking channel. I'm going to jump over to the BDC BCAP program, and the good news here is that this program is available in both the small business banking channel as well as the commercial banking channel. So this allows for term loans with amortization periods for up to 10 years for non-real estate secured deals, or up to 20 years for real estate secured deals, and it's to provide additional liquidity by financing operating expenses for companies that have been impacted by COVID. So with this program, BDC takes an 80% interest in the loan. Repayment is principal and interest, but there is a first-year interest-only option available. And within this program, there's 3 segments based on company revenues, with loan sizes ranging from between $312,000 to $12.5 million in size. Again, depending on the size of the company, from a revenue perspective. I won't get into too many details, but I will just note that there's also a mid-market junior BCAP program for larger companies where loan sizes range from $12.5 million to $60 million in size. Both the EDC BCAP and BDC BCAP programs are available until June 30th, 2021. And I want to highlight that the presence of these programs cannot be the sole reason for underwriting the credit facility. So banks are not just able to authorize these loans simply because of the guarantee or participation of BDC or EDC. The bank really has to be comfortable with the company's risk profile and that the company can repay the loans after the COVID-19 crisis. And one final COVID-related financing program I want to talk about. This is a newer one too. The BDC Highly Affected Sectors Credit Availability Program. So this is a very new program that was recently announced, and banks are at varying stages of this program being rolled out. So I can say at TD we're very close to having this rolled out, but it's not quite there yet. I know some banks have a portal already set up to be able to apply for this program. But the program is intended to help businesses that have been very much impacted by COVID-19 by providing term loans ranging from $25,000 to $1 million in size. The loans are for businesses that were financially viable pre-COVID and have seen their revenues decrease by 50% or more in at least 3 of the previous 8 months. With this program, BDC provides a guarantee for 100% of the loan, and it's structured with a 4% interest rate and an amortization period for up to 10 years. And similar with the other BDC BCAP program, there is up to a 1-year interest-only period that would be available. So those are some of the COVID-related financing programs that are out there. There's participation from the various government entities in terms of supporting the banks, providing these facilities to borrowers, but all of the underwriting is done with the bank. So you would be talking with your existing banker on any of these programs. And the purpose of the last few slides here was just to give everyone a very high level understanding of what's out there. The specifics in terms of the structuring and underwriting will vary slightly from bank to bank, but big picture, this is what the various programs look like. Beyond that, I'm going to jump into some other tips and strategies. The first tips and strategies I want to focus on are some of our conventional financing programs. So things you might want to think about first before you look at some of the COVID-related financing programs. So first off, on operating lines. So we provide operating lines to finance working capital, and we're financing accounts receivables and inventory in this case. One tip I'll say here, and it sort of ties into Mustafa's tips from his presentation, is not only make sure that your company has an operating line, make sure that your company has an operating line that's right for your cash flow needs, that it's the right size. You know, if you feel like your line of credit is too small relative to the accounts receivables you're financing, the inventory that you're carrying, the sales that the company's doing, you know, talk to your banker about seeing what are the possibilities to increasing your operating line. In certain industries, we're hearing of accounts receivables being stretched, so it's taking longer to collect your accounts receivables. One item I'd recommend here is thinking about accounts receivables insurance. So not only with, you know, the higher risk you may have with your clients in this pandemic environment, that your clients may be at greater risk of being unable to pay you, maybe staying in business. You want to think about having a company insure those receivables so that if your clients become insolvent, you know, you're not going to be at a total loss for whatever receivable is owing to you. And what's more with this strategy or this tip on insuring receivables is that banks will be able to lend you more against accounts receivables that are insured versus domestic non-insured accounts receivables. If you're in a situation where you have a large line of credit and it's being margined monthly, where the bank is measuring, you know, the accounts receivable levels you have versus how much you're borrowing, you know, typically banks will lend around 75% against domestic accounts receivables. If they're insured with an approved provider such as EDC or Euler Hermes, banks could lend up to 90% against those accounts receivables. So that also helps with liquidity and cash flow, being able to borrow more on your line of credit. We have an equipment financing arm, TD Equipment Finance. So we provide capital leases and loans on vehicles, equipments, and leaseholds. So again, with the focus and importance on liquidity, if you bought a piece of equipment using excess cash or working capital recently, but now you're feeling tight, one thing to consider here is that you may be able to refinance that equipment you paid cash for with a sale leaseback. So goes back to one of Mustafa's points on just matching, you know, long-term financing with a long-term asset. If pre-COVID you were in a very good cash position, you paid cash for some, you know, some long-term assets, perhaps now you may want to think about refinancing those assets so you can replenish your company's working capital. On the commercial mortgage side, so we can do mortgage financing on commercial properties that are owner occupied or investment properties. And similar to the point above, if you know, if you've invested in real estate and you have some excess equity there, you're feeling tight from a liquidity perspective, perhaps you could tap into that real estate with a conventional mortgage to you know, to increase working capital for your company. One product that's been very popular over the last year as we navigate through this environment are our real estate secured lines of credit. So we now regularly underwrite lines of credit against real estate. So if you have unencumbered real estate and you want that extra liquidity in the background, you could consider setting up an operating line against your building so that you have a buffer. The advantage with the real estate secured line of credit versus a mortgage is that if you have that line of credit out there and you don't need it and you're not borrowing on it, you're not paying interest on that. Whereas if you have the mortgage, it's fully drawn, then you are paying interest on the mortgage. I do want to touch on cash flow loans. We are underwriting loans to finance acquisitions, equity takeouts, dividend recaps, share buyouts, and to help with estate and tax planning. So this is important to note because we are seeing some owner operators who are near retirement and then with COVID happening have really started thinking about their succession plan. So for larger businesses, lenders can look at what we call cash flow loans, where we may not have tangible collateral for our loan, but we're valuing, relying on, and lending against the company's cash flows. So in these cases, we could perhaps finance second generation, the children buying out the first generation parents, management buyouts, that type of thing. So we are doing that. Those loans are, I would say, more suitable for larger businesses where there's a healthy, sustainable level of cash flow being generated by the business, but something to think about from a succession planning perspective if you are looking to you know, to finance that ownership transition. And I'll just move on to the last slide here. So just other tips and strategies. You know, your banker is a partner. Your banker is invested in your company's success. They succeed when you succeed. The risk items that your banker looks at to protect the bank or the bank's investment are the same risk items that you want to be looking at. Understand the COVID impact your business. So make sure you can speak to your banker on how COVID has impacted your business. Be able to articulate the impacts to the income statement and to cash flow so that your banker can understand what's happening. Financial projections help, even if projections are not part of annual reporting that you deliver to your bank. If they're already being prepared internally, and that would be very helpful to share with your banker. And from a financial reporting perspective, quality information helps. Higher quality information could help your business be approved for potentially more money and faster. So going back to a part of Ramke's presentation and having a good understanding of some of the financial reports and metrics from an internal perspective, also very important from an external perspective, so that you can deliver good quality, reliable information to your banker, so that your bank can help you get to where you need to be. Finally, just being proactive. So, plot out and project your company's cash flow. If you're feeling stretched from a liquidity perspective, don't wait to talk to your banker until your operating line is fully maxed out and stretched. Start the conversation as soon as you can. And I think this was on Ramke's point on the covenant side. If you think you might be offside on a financial covenant, talk to your banker early on, right? So track your financial bank covenants internally. If you think there's going to be an issue, engage your banker early on, so there are no surprises, so you can work together to get things back on track. Maybe the bank waives the covenant, amends the covenant, or together you'll work on how making a plan to get things back on side. So those are just some tips and strategies that I see in my end on the banking and financing side. That's everything that I have. So thank you very much, and I'll turn it over to Scott.
That's great. Thanks to James, Mustafa, and Ramke for great presentations. As we were planning this webinar, we were talking to SB and TD about possibilities, and we kind of knew that we had three very knowledgeable people to draw upon, but the information today was just amazing. So thank you all three. A reminder to everyone that if you have any questions, you can just put them into the chat room. James, I'm going to talk to you first. You talked about the SBA loans and the 40 and the 60,000. I know a lot of businesses are I guess frustrated in a way because they applied for the initial funding, but then it seems a lot more complicated to get the extra 20. Are you finding that that's true?
Yeah, we are finding that. And I'll just say a couple of comments for the folks on the call today. So the SBA loans don't sit on the bank's balance sheets. We sort of administer, collect the information, and a lot of that is the checks are done by the government. What I've heard is that for the first round of the SBA loans, I don't think there was as much scrutiny on the first $40,000 coming out. Now with this additional $20,000, the government is doing some more checks. There is an attestation to need. So there is some kind of an attestation the company has to do in terms of showing they really need this other $20,000. But unfortunately for us, my group is not underwriting the SBA loans. That's one centralized, one item that's centralized that we've got a different group looking after. So the very specific items on SBA I can't speak to, but I have heard that it's tougher to get that other $20,000. And my understanding is because the government's applying more scrutiny on this round of applications.
Right. To either Ramke or Mustafa, we've talked a lot about the wage subsidies, all the different subsidies that are available over the last year to businesses. Do you find that there's a concern now about a false economy, that a lot of businesses use that money to survive, but now in the next 6 months to 12 months, we're going to see other concerns?
Yeah, so I can take that. So Scott, I think what will happen is businesses did need that injection of funds to survive for the past 12 months. Now, if some of those programs have started dropping off, we will find that they'll have to come up. They'll have to really buckle up and improve their performance and look at all the other things we've talked about to make sure that they are still a sustainable business. So the programs we know were not going to last forever, and business would have known that. So at this point, they must be thinking, what do we do next, to improve our performance?
Right.
And
ahead,
building on Mustafa's point, that's something that us as underwriters are looking at. We could be seeing credit requests for companies that are showing $100,000 in profit, but they've collected $400,000 in wage subsidy. So if you were to normalize that, you got to think about, of course, there'll be top line impacts from COVID. But you need to think about, okay, when things get back to normal, what will that cash flow look like? Can the company achieve profitability? So it's an interesting point that we're looking at too, sort of normalizing the impacts of cash flow from those, from some of those programs, because they won't be around forever, right?
Right. And Ramke, you were talking a lot about the key performance indicators, things like that. A lot of things that the businesses should be doing in terms of their self-analysis. But do you find that a lot of businesses are still treading water and they're still trying to survive, so they can't do that kind of day-to-day analysis than they need to do?
I think it's a chicken or egg situation for them. Like, do they have to do this in order to sustain there or not? But I think, it's like searching for a dark socks in a dark room, right? Like you need to know what are your key performance indicators, like where are you losing money? Like one of the things, like they say, oh, sales was dropping. And I say like sales was dropping because of COVID. But how much effort have you put in for marketing initiatives? Who are your potentials? How are you talking? So look at your KPI. It gives an indication. So, this is like how Mustafa mentioned about diagnostics. I think that there's something wrong with my body. I think I have blood pressure. But looking at the metrics is when you really understand how bad it is. So I will encourage people to look at KPI. What actually drives the business? What actually generates cash in the business is something that businesses will have to determine. The other thing, just to touch upon the subsidy, is I think, we cannot run business based on subsidy or trusting that subsidies will come. It's a very wrong indication to the businesses to say, okay, I can keep it going because I expect subsidy. You'll have to take that as a contingency and say, okay, what if we get money? And that's the way you have to look at it. But it should not be really running a complete business model of government grants or subsidies. It'll just set the business for failure.
So you're touching on things like marketing and sales. We've talked about accounts receivables. Whoever wants to answer this question, do you find that there's one area of a business that's being neglected a little bit more than others through COVID? So, is it mainly AR and the billing cycles that's been ignored?
I think if you look at it, the heart is the working capital. When we put piles of inventory on the racks, it's actually piles of cash sitting on those racks. So, I think people don't look at inventory management now, they look at just sales. That they say, okay, if my sales are good, I think I'm good. But they don't look at the cash. Like what's my, net retention of those cash from those incremental sales. So if you don't retain cash, you're churning more cash to generate those sales. It's setting up, the business to fail in the long order, because cash is not the priority. So I think I would say working capital, the cash from operations is the most critical thing that businesses will have to look at now.
I'm aware of the time, and our show is coming to a close. So to James, Mustafa, and Ramke, is there anything else that you want to touch on before we close off?
I know, Scott, no, thank you very much for this opportunity, much appreciated. It's always nice presenting to the chambers, and mostly because I think I know everyone on the chamber for that matter. But so I do appreciate that. And if any questions, we can always be called offline as well.
Yep.
If anyone needs our presentation, that's available. But we're here, we're still, servicing our clients. So we're here to help anyone that needs it.
Perfect. Well, thank you all three. Sorry, James, to cut you off.
Oh, no, I was just going to say I echo everything Mustafa's saying there. Happy to chat. If anyone has any questions afterwards, feel free to call or email anytime. And thanks again for the opportunity.
Perfect. And we've talked about all the slide presentations. We will have those available on the chamber website as well. So just look for those in the next few days. Thank you again, all three of you, James, Mustafa, Ramke, for taking time to do this. Thank you for everyone that tuned into the show. Mustafa was talking earlier about the chamber providing information through COVID. That's been a big part of our role, is trying to make sure that all the government information was passed along to the business community, so everyone did know how to take advantage of the different programs available, and to be able to ask questions like we've done today to keep informed. So So again, thank you to everyone for tuning in. Then we'll see you next time.
Thank you.
Thank you.
Thanks, everybody. Have a good day.
Cheers.